It's that time of the week again. It's time for the ESPC show, and it's Paul and it's
Megan.
So it is. And this week, friend of ESPC, friend of the show.
Yeah, Andy Lewis is back for his second episode on the podcast, and today we are talking about inheritance tax.
We certainly are. That's Andy Lewis, not Martin Lewis. We're not quite that big, are we?
No, not yet. But yeah, as I say, only two things certain in life: death and taxes, and we cover both today.
We do. But it's not as dry as it sounds, and certainly I think what surprised me was that there's a lot of people that are potentially going to be caught up in this in the future. And so it's a really worthwhile listen, I believe.
Yeah, and also provides some reassurance of how you may not qualify for it. So I think, really interesting for anyone who wants to do some future planning.
Common theme. Go early, talk to people like Andy early, and you'll see why once you watch the show. So here we go. So today we have a special guest on the show.
Yes, we've got Andy Lewis here. Andy, I don't know if you want to introduce yourself.
Hi,
friend
guys.
of ESPC.
Yeah, indeed.
How many times have you been on?
Well, so this is my second time,
right.
yeah. So obviously the first time wasn't too bad, otherwise you wouldn't have asked
Or
me
you've come back
again.
to re-explain the answers from us.
Possibly, yeah. No, great to be back and to see you guys. So I'm Andy Lewis. I think, as I mentioned last time, I'm a financial advisor with a company called Scott Davidson Ltd. Here to talk about some subjects, I guess, that are important to people and try and make it as exciting and interesting as possible.
Well, it's going to be a bit of a challenge, but if anyone can, Andy can.
I'll try my best.
So we're going to talk about the interesting and stimulating subject matter of inheritance tax. Very current at the moment.
Yeah.
All over TikTok at the moment.
Yeah.
Is it TikTok? I'm definitely not down with the kids, so I don't look on TikTok.
Yeah, so we were saying, weren't we?
Yeah.
So I mean, I wonder if the first starting point here is maybe just explain, because it's a phrase that gets banded around a lot, what inheritance tax is. Actually, how often does it really apply?
Yeah, okay, so look, I think it is quite a complex area. There's a lot of moving parts within it, a lot of variables. So I will try today to just make it as simple as possible for people to understand. I think the first thing to say is inheritance tax has been around for quite a while in some shape or form. I think if you went back to around 1690, it's around about that time there was sort of death duty and estate duty. Didn't change name until late 1890s, and then from, I guess, the form that we know it in was sort of mid-80s that it came around and got renamed in inheritance tax. And in simple terms, it's effectively a tax on a dead person's estate, for want of a better example, just to simplify it. It's a very much maligned tax, I would say. I think, as I was saying to you earlier,
it wouldn't win the popular vote.
But I think it's also maligned and misunderstood, perhaps. I think if we went out into George Street right now and we stopped 10 people and asked them what they thought about inheritance tax, you would get a variety of answers and responses. I think, ranging from ambivalence to, it's the worst thing in the world, So I think it's quite an interesting tax that is on or used in the UK. I think, just to put it into context though, I think the latest figures that the Chancellor talked about last week when she was doing the budget indicated that there's around about 6% of estates paid it in the last financial year. Okay. So, that's
94 didn't then?
Yeah. Okay. So effectively it's not a tax that impacts
sort of VAT
that many people.
And the like, okay.
Yeah, so 6% of the population. Now, again, we'll talk about it a little bit later on this. There have been some changes that she announced last week that might bring more people into that range. But yeah, I think it generated around £7 billion for the coffers last tax year, and about 6% of the population paid it. So it's a much maligned tax, much misunderstood tax, but not lots of people are impacted by it.
So, Andy, when does it apply then? Who are the 6% that it applies to?
Again, in really simple terms, and I will talk about some of the sort of little complexities that go alongside it, but at the most basic level, no inheritance tax applies to an estate under the value of £325,000. Okay? So that's your ceiling, and a really important number to bear in mind.
When you say the estate, so that's every asset. So that can be the property sale, the jewellery, the car, the whiskey, just everything.
It's property,
Any
it's
asset.
money, cash, assets.
Right.
It's those expensive paintings you've got in your wall, Paul.
Course,
you know,
yeah.
you
From
know, all
IKEA,
that,
yeah.
all that sports memorabilia you've been storing up for years. All those expensive bottles of whiskies. Yeah,
Yeah.
all of that. You know, family heirloom jewellery,
Yeah.
that type of thing. Everything in your estate. Okay, so that £325,000 is a really important number to be cognizant of. If you have a property and you are passing that property on to a direct descendant like a son or a daughter, you get something called main residence nil rate band as well, which is an additional £175,000. Okay, so if you imagine you've got a house, you've got some assets and cash, you pass that house on to the next direct descendant, then you've got £500,000
Okay.
before you need to worry
Right,
about any
okay,
inheritance
right.
tax liability. Right?
I don't want to use the word "that seems reasonable" here, but that does seem quite reasonable.
Well,
yeah.
I would say when they put the current thresholds into play, which was nearly 2 decades ago,
Yeah.
I would probably agree with you.
Yeah.
But the fact that they haven't moved up,
Right. So it
with
was values
inflation,
of right. Okay.
yeah.
So it's not index linked or anything. Okay.
no,
Right,
no,
Okay.
it was originally meant to
Okay.
be, but
I'll withdraw my statement then. Yeah.
yeah. So I think as time goes on,
Yeah.
it becomes much more likely that more people
Yeah,
will
cool,
get drawn
right.
into it, right? I think one of the other things that's really important to think about as well, if you're a married couple or in a civil partnership, you've effectively got 2 of those £500,000 to play with, okay? So you can have £1 million of an estate,
Okay.
pass it on to the children.
But
Now,
potentially they may be coming from 2 sources. So if and we're not, but Meg and I were like, man, there would be Megan's side and then my side. So
Yeah.
the million is in total, isn't
yeah,
it?
yeah, but you have to be
Right.
married, right? So this is
Right,
where
okay.
plug for getting married or advert for getting married.
Had a few of them on the show.
Or a civil
Yeah.
partnership,
Yeah.
then that
Right,
that's
okay.
important to have. I guess the other thing to just be really cognizant about of, clearly if you have a property that's worth less than £350,000, because
Yeah.
that's the 175 times
Yeah.
2, then you can't use £350,000. So if the property is worth £300,000, you only get £300,000 within that
Yeah.
level of it. Okay, so it would reduce your number slightly. But in simple terms, if you're in Edinburgh and you've got a nice, £400,000 house, then you get all of that main residence relief as long as you're passing it on
Sure.
to direct descendants, and then anything else, as long as it's within that £1 million, there's no sort of inheritance tax to worry about. Also, you can set it up so that if you pass away first, Paul, let's assume you and Megan are married.
So rumours start. Yeah.
You automatically transfer over. So if, say you had in your own situation an estate that was worth more than the 325, there would be no inheritance tax to pay at that point because it would automatically transfer over to the spouse. And that's where the kind of benefit of a marriage, as well as being happily married, comes into play.
Yes.
One thing to be aware of, though, if you are lucky enough to have a situation where your estate is worth more than £2 million, the main residence nil rate band, so that £175,000 and times 2 if you're a married couple, starts to taper off. So basically, in a married couple in that situation at 2.7 million, you lose that basic relief essentially. Sure. Okay, so it tapers off once you get over the £2 million mark. But in simple terms, that's how it works, as long as that sounded simple, Megan.
Andy, sorry, this is maybe getting really into it, but in terms of, so if you pass your property down to your descendants and they sell it, does that incur any?
Well, if you're selling it on, if you're passing it on to them, and what do you mean, they sell it straight away? As long as
they inherit it and then
they
like
inherit it
a
and
year
then
later
decide,
or something, or
they're not going to move into it, and
so there could be other taxes that impact them. You know,
Okay.
potentially like capital gains tax or
Second
things like that,
residence,
second
Okay.
residence tax. But from an inheritance tax point of view, as long as it's within the confines of what I've just described, then there's no inheritance tax
Right.
to pay on.
Okay.
All right.
So to inherit it, there may not be, but as you say, if you then realise that asset by selling it, you could get into
Other
taxes.
Yeah. One thing that's often
Everywhere you go, isn't it? It's every angle, isn't it?
well, I'll
Can
let
you
you
ruffle
I'll
it?
let you say that, not me. But yeah, and there's little things to sort of think about on top of that as well, because you could have a scenario nowadays where people are living longer, and they might pass on an estate to a direct descendant, and then that direct descendant might inherit that, and that might add to their estate, take them over, and that could create a problem as well. Indeed, you could have a scenario where a direct descendant inherits something, there was some inheritance tax paid because it was over the level, they then pass away quickly. You're like, hang on a minute, we've paid the inheritance tax on that, we're now going to pay it again on the second death. And so there's things like, it's called quick succession relief, which tries to soften the blow a little bit of that second scenario happening. So like I say, there's a lot of moving parts and a lot of complexity, and certainly what I would say, and probably should have said it at the outset, if that is something that's on the mind of someone, then really seeking advice is important, right? Yeah. And one of the good things I think that came out of the budget, and the fact that it was probably the most talked about budget, certainly one that I can remember, is that hopefully it gets families talking about stuff like this, because actually with careful planning, you can actually reduce or mitigate some of the exposure that you might have. And what you don't want to do is, I think, used to have generations that were stoic and didn't talk about money. We don't talk about money, and unwittingly walk into a scenario where they pay inheritance tax, when actually some conversations earlier on might have made that work out a lot better. So I would certainly say advice is important. Make sure that you speak to, that could be a financial advisor, it could be a solicitor as well, because they can also help with estate planning. But have the conversation as a family.
Going to say, maybe, I'm sure you see this, Andy, that it might be the family that come to see you rather than just one individual, so that everyone's hearing the same thing at the same time.
Yeah, absolutely, Paul. I mean, I regularly sit down and rather than advising individuals, you are trying to advise the family unit, because there's going to be a massive transfer of wealth. I think we've talked about this before, massive transfer of wealth between generations over the next few years. So it is important that everybody's on the same page if they can be. Not all families get on, so but where possible, I think that's a really good thing.
And getting the advice from a properly qualified expert in this, because it is quite a complex subject as we're learning today.
Absolutely. And I think the thing that underpins absolutely everything in anybody's financial plan, and it's clearly relevant for inheritance tax and that side of things, is making sure you've got a will that's up to date. Yes. Because if you die without a will, that creates a whole host of problems and complexities. So that is the bedrock of everything. Make sure that you have a will. I think that the last sort of bit around broad brush inheritance tax is that anything over that amount of money that we've talked about, so over the £1 million, is taxed at 40%. So it's not an insignificant amount of money that you're potentially going to pay out, So I guess the way to look at that, all things being equal, your estate's £2 million, you're paying 400k in tax, right? If you leave 10% of your estate to charity, they'll give you a bit of a discount, and they'll charge you 36% on the remaining estate. But even then, it's a still significant amount of tax. Now, again, we go out in the George Street and we ask 10 people. Some people will say, well, I'm okay with that, actually, because I'm quite comfortable that I'm going to be paying tax and that money is going to be put to good use for the country, right? And then you get the opposite end of the spectrum of, they've taxed me all my life, they're not going to tax me when I'm not here. And so everybody's different, and that's why it's really important that you look at your own circumstances, and that's the discussion and the basis that you have it around.
Yeah, okay. You've spoken a lot about, as you say, when it applies and whatever. Was there anything, I mean, it was the most talked about budget for a long time. Was there anything significant changing in that? There's been lots of headlines.
Yeah.
And we've heard a lot about farms, which obviously is a relatively small area, but just any thoughts on that, really?
Yeah, I mean, I think look, there's three big things that probably changed from the budget announcement last week. So I'll talk about each of them individually and make reference to what you've just talked about. I think the first thing is those thresholds that I mentioned, the 325 and the 175. So they've been frozen. They were originally frozen until 2027. That's now going to be 2030. So if you think about that, in a world where inflation's been not great in recent years, that potentially brings more people into inheritance tax. Again, unwittingly, potentially. So we could have a scenario where those freezes effectively mean that more people are paying it, and more people are paying more, if you like, So that was one of the big pieces around it. And I guess maybe that doesn't get the headlines because it's maybe perceived to be more of a stealth tax, because you're not really moving the goalposts, really. You're just keeping them as they are whilst inflation creeps up, you know. And I think the other bit to point out with that is that that's 2 decades worth of a freeze when we get to 2030. Now, I know if I think back 20 years, things were significantly different in terms of pricing and values, you know. You could probably afford to buy a flat in Edinburgh as a first-time buyer back then, right? So yeah, that's one of the sort of key changes that have happened. Yeah. The other bit is one of the other ones is just around about what you said there around agricultural and business relief. So, and this change is proposed to come in 2026, but essentially £1 million, if you're a farmer or you've got business combined, you can pass on with full relief. But anything above that gets half relief, 50% relief. So effectively, you'd be paying 20% tax on that above that £1 million. Now, again, depending on what newspaper you read, depending on what part of the world you work in, that'll be more painful for some than it is for others.
You're hearing a lot about asset rich, cash poor. You know that was some of the comments the other day from I think it was Farmers Union saying that. Yeah,
and I think also there's concerns around what it might do when. I think traditionally, I'm not a farmer, I don't know too many farmers, but traditionally from the outside looking in, it seems to be the type of business that is
always
passed
hands,
down through the family. So I think that is definitely probably an unwanted additional concern that people might have around transferring that business onto the next generation. And I suppose being an island country, is that the best thing if there's less farmers producing food? You know, so I guess there's maybe a whole host of unintended consequences that might come along with that. I'm just I guess expressing what I've seen as a result of that change. So that's definitely something that people need to be cognizant of as well. There is an element in there around. Have you ever heard of AIM shares? So they tend to be.
I haven't. That doesn't mean
the AIM market. Yeah. So I know what the
so
AIM market
you know
is,
the type of shares, smaller companies.
Small cap.
Again, to incentivise people to invest in them, there was business relief attached to those, and that's also going to change alongside that as well. So that potentially has a knock-on impact potentially into investment into those smaller businesses, perhaps if they're not as seen as being
as attractive as the FTSE or whatever. Certainly higher risk.
So why take that extra risk if there's no relief that sits around it in the way that there currently does? So that's going to also reduce to that 50% level. I think probably the bit that I'm getting most sort of questions around and conversations around is the third sort of area of change within inheritance tax, and that's the fact that pensions are now going to be brought into the equation from an estate calculation point of view. So that's legislation that's potentially going to come through in 2027. So it was announced in the budget, it's going out to consultation. The legal framework and all the legislation that comes with it will follow suit. But as I say, it's going out to consultation now. The likelihood is it probably will come in 2027. It just means that where people were building up pension pots and perhaps using that as a bit of a strategy to efficiently pass wealth on to the next generation, because effectively the pension went to the next generation or who you wanted it to without an inheritance tax concern. Now that comes in, I think if you think back to the threshold freezes, that will bring potentially more people into paying inheritance tax. And I think there's been various different calculations as to how many people that might bring in and by when, but I think it was the OBR, so the Office of Budget Responsibility, had said that it's probably going to be around 10% of people that will come in. So, rough maths, that's almost double where it is right now. So, and I think what it does potentially mean is that people who had been planning in a certain way with maybe leaving some of the pension pot to the end to pass on efficiently will now maybe need to revisit those plans. So again, that's where I think engaging with someone from an advice point of view is really important, because that might change again in a few years' time in some way. And I think that's the.
But you can only go with what you know at that point, can't you?
And that's what I was going to say, Paul. I think this budget, like any other, no other really, has had a lot of people making decisions and doing things based on what they've read in the press or they've seen on TV. And that's quite a dangerous thing to do because they weren't fact and it wasn't definitely what was going to happen. So I think, we were talking about tax-free cash out of a pension. There was a massive rumour that was going to be changed, reduced or, looked at, and it didn't happen yet. I know that there was some clients of certain businesses that decided to take that
just
money out.
Early. Wow. Yeah.
Which it's almost like the lesson here is deal with the facts and make decisions based on fact rather than what might be happening. Yeah. But the pension piece is going to be, it's going to be something that people need to be cognizant of if that's been part of the plan up until now. Because I think one of the most important things for a pension is that you don't run out of money in life, right?
Yeah.
But it was always in recent years seen as something efficient to be able to then pass on to the next generation, and that from 2027 starts to be removed. I think the one thing to point out about that is it's really defined contribution pension pot. So defined benefit scheme is where the good old schemes that don't really exist anymore, where you had a final salary and there's not really a pot of money left there. But with a defined contribution scheme, typically there will be, either you've taken an annuity or you've started to access it. There's going to be a residual pot there. And what will happen is the pension scheme will end up administering any IHT liability that's there. And then that will then get passed on to the beneficiary. Now, the double whammy here, and the devil is always in the detail with it, is at the moment, if you die before 75 and the pension gets passed over to your beneficiaries, there's not usually any income tax liability. But if you pass away after 75, then it gets taxed at the beneficiary's marginal rate. So, let's just say that you're 75 in a day, or 76 just for clarity, and you pass away and your pension forms part of your estate, it gets the inheritance tax hit. And then when it lands in the hands of your beneficiary, because you've died over 75, there is potentially an income tax liability on that too. So there's almost like a double whammy tax hit in that scenario. Now, again, this is just my opinion. Perhaps that is something that is going to be talked about in the consultation, because that doesn't feel
no,
it doesn't feel great.
Wow. Get good news, Andy.
so look, I guess
you didn't touch VAT. There you go. That's
look, I think that is one of the things that that was definitely clear about the budget. There was a lot of noise around a lot of things, but I think the budget was going to generate £40 billion worth of new money or monies to be able to go and do the things that the government wants to do. So it's a difficult. I mean, I do have a bit of sympathy for a chancellor who's having to make difficult decisions and trying to find ways of generating income, but that's probably where the sympathy stops.
It's probably a conversation for another day, isn't it? But
yes,
okay.
Indeed.
Andy, I wonder if I can just touch on something that might affect some of our listeners. So you mentioned before, if someone is considering how they can maybe best prepare themselves for efficiently preparing, they might be gifting money to grandchildren for house deposits and things like that. Yeah. Is there any possibility, if would that be subjected to inheritance tax at any point?
So, simple answer is yes, it could, right? Okay. But there's a few, I guess, complexities and considerations that you need to think about. So I think this kind of leads into, okay, so I'm looking at my estate, my situation. What's the best way to efficiently pass things on? And you've got a number of different options. Well, the first thing is you could enjoy your money, right? So that often gets forgotten about. Yeah. Like you've
big
worked,
family holidays.
you've worked for potentially a long period of your life, hard. You've maybe built up some assets that take you into that world. Enjoy it. Like you can't take it with you, right? So could be family holidays. Whatever, right? So I think that is something that's forgotten about within all of this. Got to try and enjoy it, right? But then I think there is some careful planning you can do around gifting. So that's predominantly the area that I think we're probably talking about. This is where I'm going to get a little bit technical. There's two types of main gifts, and actually inheritance tax, believe it or not, can also apply when you're still alive, right? around something called a chargeable lifetime transfer, okay? So a CLT for short. And what a CLT could typically be is you transferring money from your estate into a trust setup, so like a discretionary trust. Without going into loads and loads of detail about trusts and how all they work, because that's probably a story for another day, as long as you keep that under your nil rate band, so 325, there is no sort of chargeable lifetime charge on that transfer into the trust. But if you're throwing in £500,000 into that trust, then you will have a charge to pay. So that's one way you can do it. You can set up trusts and have a legally binding document that then says, this is how much I'm gifting into that trust, and these are the beneficiaries and all the rest of it. So that's an efficient way of you estate planning. But it's quite a formal thing to do. The good thing about that from the donor's point of view is that they retain control over how that money's invested, and they stop the person that's taking it potentially going and wasting it and all the rest of it. So there's a bit of control around that. The other type of gift, broadly speaking, is called a potentially exempt transfer, right? And that's probably, if you're not going to do any formal estate planning, that's probably what most people will end up doing, okay? And that's where you gift to, you know, a son, a daughter, or a family friend or whatever, and you gift that amount. Everybody has £3,000 a year of a gifting allowance that they can provide. So if I gave you £10,000, Megan, I know that 3,000 of that wouldn't be impacted by inheritance tax should I go over the thresholds. And if you don't use it in 1 year, you can use the previous year. So you can have 2 years effectively. So £6,000 if I've not made any other transfers. So that type of gifting is a good way of, you know, almost seeing the benefit of you know, if that £10,000 helps you to buy a property, I'm delighted because I'm getting to see that happen, and, you know, I'm getting some satisfaction from it. I think the key thing that you've got to bear in mind, and the reason why it's potentially exempt, if I live for 7 years after I've made the gifts, and all my gifts, you know, are within that threshold of 325, as we've sort of talked about earlier on, then there's no inheritance tax liability. If I pop my clogs, and as well as giving you the £10,000, I've gifted lots of others to other people, then there is potentially some inheritance tax due if I don't live for that 7 year period. So 7 years is a key number to have in your mind. So from you giving that gift, 7 years is the kind of time when it drops out of your estate from that point of view.
Again, underlines that point about talking earlier about these things.
100%. And there are other gifting allowances that are in play as well. So you can give an unlimited number of £250 away to individual people. So, you know, if and Christmases and birthdays are excluded out of that, but if I had 10 friends that I wanted to give £250 each to, I could do that legitimately within everything. And then, again, back to the marriage piece. So if my son or daughter's getting married, I can gift them £5,000 to help pay for that wedding. And again, that's a legitimate amount of money that can come out of my estate as a result of that. £2,500 to a grandchild, £1,000 to everybody else who's getting married. You know, so there are, and again, this is where it's really important that you engage with an advisor or a solicitor. There are legitimate means that you can gift and allowances and reliefs that you can use to, I guess, manage that inheritance tax position that you may or may not have. If you are in the realms of having an inheritance tax liability when you're gone, keep a really good record of your gifts. So almost like, in fact, this is what to do, is get a spreadsheet or get a little book and mark out who you gave the gift to, when you gave them it, and how much you gave them. Because again, if you think about the fact that you won't be here anymore, someone else has got to pick up and administer your estate and you pass away. If it's there and it's easy to understand, then it just makes life easier at the other end, and any calculations need to be done. So I would say good record keeping is really important within all of this, so that you know who you've given what to and when, importantly as well. There are other things that you can do. So, you know, potentially exempt transfers like gifts, essentially, chargeable lifetime if you're going to set up a trust and all the rest of it. You can also take out life insurance. So whole of life insurance where you would pay a premium each month based on what you think that inheritance tax bill could look like. So in the example we talked about earlier on, £2 million estate at the moment, 40%, 400k, I could get whole of life insurance for myself that would mean that when I pass away, that money's written into trust, because we don't want that adding to the estate. That money's written into a trust, and on my death, everything's getting actioned. Yep, we've got 400,000 to pay on inheritance tax, but we've got this 400,000 that Andy left behind for us through the insurance company to go and pay that. So that's another sort of option that people have if they want to try and reduce any potential inheritance tax liability.
Good.
Yeah, I think if people are then sitting thinking, oh, I actually don't want a gift, I don't want anyone to be I don't want to be liable for inheritance tax.
Yeah.
What should they maybe think?
Well, I mean, I think one of the things that's really misunderstood about inheritance tax is that a lot of people think that they are liable for it or potentially liable for it when their estate means that they're not. So, if I've got an estate of £200,000 and I pass away, I don't need to worry about inheritance tax. Now, my executors might have to declare something to HMRC that I've passed away and this was the size of my estate, but there's no inheritance tax to pay on that. So, if I wanted to give some of that £200,000 away before I passed away, I don't need to worry about that.
Yep.
It's really when you start to get to those threshold levels that we talked about, the 325, the 175, and if you're in a married couple, the the £1 million, if the property allows you to be at that level, that's when you need to start sort of thinking about, okay, maybe there's some action that I need to take here if I don't want to be paying inheritance tax. I guess one of the things I should have also said about the gifting piece is invariably the gifting element can actually end up meaning that the person that's received the gift can pay inheritance tax too. So that's not a nice thing to potentially have, I've given you £100,000, Megan, to go and buy that property. You've put it all into the property, and because of the number of gifts that I've given away in that 7-year period before passing away, means that there's an inheritance tax liability. It could be that you have to pay that inheritance tax. So that's why conversations, good record keeping is really, really important, so that everybody's kind of on the same page with all of that.
But when it comes down to it, we've spoken a lot about it today, who actually pays it? Yeah,
so effectively it's funds from your estate that are used to pay that. So usually people hopefully have a will in place, and the executor of that will and the solicitor will work through the detail of that, and then that's when it's paid.
Or the pension people in the pension situation.
Exactly, but that'll all be collected within the overall estate as well, Paul. And I think you've got about 6 months between the person dying and paying that bill. There are little nuances where you can pay in instalments for certain things, but again, always be close to the solicitor.
If the property hasn't sold, what happens then?
Exactly.
So if you've got a bill and you've got no assets to pay that bill.
Exactly. So that's where you would definitely work with your solicitor, as the executor would do, and just making sure that that's clear and that there's an instalment plan or there's something.
Yeah, we recognise this to be paid, but look, we need to get this property sold.
Exactly. But yeah, as I touched on earlier, in the main, that's who pays it. So you die, the executor, solicitor sort all that out. But if you've received a gift and the 7 years haven't evolved and there is an outstanding liability, it could be the beneficiary of that gift that has to pay some inheritance tax as well.
As you say, the more you talk, the more go early, lay everything out on the table, take the family and figure it out. And I say you can only advise on what we know today, and it could all change again, but I suspect we're on a sort of travelling down a certain road here, aren't we, where I think we'll see a lot of things freeze to bring more people into this.
It's an easier thing for them to do, isn't it?
I think so.
Because
it's more palatable, isn't it?
Yeah, because we're not moving the
goalposts.
Stealthy. We're keeping them as they are. Oh, but hang on a minute, that means more people come in, right? Exactly. So that's why they're doing it, right? But yeah, I think that's important to be cognizant of, is, like you say, having those conversations, engaging with an expert, an advisor, because everybody's circumstances are different, and what you might want to do will be different to the next person. But there are legitimate things that you can do that it's not avoiding inheritance tax, it's just being more efficient. So there's a little known thing called a regular gift out of excess income, which you can do. So if you know that you're sitting at a certain level where inheritance tax is going to come and knock on your door, and you are earning or bringing in monthly salary or pension or whatever, that provides a surplus every month and that's adding to your estate, you can gift that out of regular income to you know, it might be to help with living costs for you, Megan. You know, you've got on the property ladder, you can afford the mortgage just about, but you can't afford to heat and eat. So I'm going to transfer some money out of my regular excess income to you to allow you to be able to buy those things on a monthly basis. And again, this is where record keeping is important, making sure there's a clear, transparent example of that transaction occurring, then that's okay. And that has the impact of, I guess, not increasing your estate any further than it might already have done.
Sure. And
I touched on it a little bit earlier, but you can gift to charity as well. That a lot of people, I think, you know, if you think about it, there's probably a decent proportion of people out there that don't have direct descendants or don't have, you know, anyone around there that they want to leave money to. So I guess that's where the cat and dog home benefit, right? Yeah. But that can also be an efficient thing to do. Yeah. So I guess in summary with that, engage if you are in that sort of world, engage with a financial advisor, definitely speak to a solicitor to make sure that you've got your plan in place, and have the conversation with the family and friends if that's relevant as well.
Brilliant.
Absolutely.
Andy, that was really comprehensive. Thank you.
Yeah, thank you very much.
Yeah. All right.
Really
Thanks for having me, guys.
Yeah, great to see you again. Take care.
Thank you.
As you said at the start, death and taxes.
Yeah, absolutely.
Well, I thought it was really good, covered an awful lot there, and I would hope that would be reassuring for people. And probably underline, we were just talking off air, weren't we, that, you know, just go and get some advice.
Yeah.
It's one of those things, you're busy lives, you put these things off, but you know, the earlier you go, as Andy was explaining, you know, the more important that becomes, certainly with that critical 7-year period he was mentioning.
Yeah, absolutely. So if you enjoyed listening to today's episode, as always, please hit subscribe wherever you're watching or listening. And if you want to ask us any questions, feel free to send us an email at marketing@espc.com. Otherwise, we will be back again next week.
Yeah, we look forward to seeing you then. Have a great week. Speak to you soon. Bye-bye.
Bye.